So we would have our first panel session for the day, and it's on fintech and venture capital. Fintech and venture capital, the year ahead. I'm sure a lot of us are very interested in this. And we have an A-list of panelists to take us through the session. So join me as I welcome Yvonne Okafor from Untapped Global. Yvonne, are you here? Yvonne Okafor from Untapped Global. Samuel Salako from DLE Piper Africa. Please put your hands for Samuel. Pardon me, please. From Enza Capital, we have Anthony Kimani. Please put your hands together for Anthony. Welcome. From Accion Venture Lab, we have Amee Parbhoo. Please pardon me if I'm murdering your names, please. Pardon me, Amee Parbhoo from Accion Venture Capital. Is that Yvonne? Oh, you're standing in for Yvonne? Amee, right? Yes, welcome. From Verdant Capital as well, we have Edmund. Higenbottam. Thank you. Please, over to you, Samuel.
Hello, can you hear me? Hello, good morning, everyone. Can you hear me? Okay, thank you. So, welcome to the first panel session of this year's event. So I have my panelists here who are here to look at the discussion around fintech and venture capital. We all know that the growth of fintech in Africa has been spurred by venture capital. If you look at the investments in tech generally in Africa, you'll see that about 75% of that goes into fintech. So the marriage between fintech and venture capital has been made in heaven. But we noticed something last year. There seems to be a drop in the number of deals as well as the money going to fintech, which is why we want to look at what does this year portend for fintech in Africa. Is this a trend that is going to continue, or is just something that can be explained by a number of factors, perhaps the pandemic, perhaps what is going on globally? So to look at all these issues, my panelists, from my right, I will give them 1 minute each, please, to introduce themselves. First, on my immediate left, Amee, please can you introduce yourself? 1 minute, please.
Yeah, thanks. Thanks so much. My name is Amee Parbhoo. I'm one of the managing partners of Accion Venture Lab. We are an early stage, so pre-Series A global investor in inclusive fintech. So we're investing in fintech companies that are serving, populations that are underserved, consumers, small businesses, largely in emerging markets. We've been investing for over a decade and have a sizable portfolio around the globe, but particularly in Africa. And really we see a massive opportunity still, even with that drop that you just described in fintech on the continent. So excited to talk about it.
Thank you very much for that very short and sweet introduction. Anthony?
Hi everyone, I'm Anthony Kimani, part of the Enza team. And a quick brief on Enza. So Enza is a multi-stage private venture fund seeking to back founders and teams using technology to solve large and meaningful problems on the African continent. We have 3 funds managing slightly above $50 million, and we invest across East Africa, South Africa, North Africa, West Africa, both Francophone and Anglophone West Africa.
Thank you, Anthony. Edmund.
My name is Edmund Higenbottam. I'm a managing director at Verdant Capital. I'm responsible for the Verdant Capital Hybrid Fund. Verdant Capital Hybrid Fund is investing in tech-enabled financial businesses which support micro and small enterprises, especially with credit, but also with other financial services. Verdant Capital Hybrid Fund is part of the broader Verdant Capital group, which is involved in financial inclusion, fintech, M&A, investment management.
Thank you, Edmund. The last but not the least, welcome, Yvonne. Please, a brief introduction.
Thank you. Hi, everyone. My name is Yvonne Okafor. I am an investment officer at Untapped Global, but also a co-founder of A&A Collective. So Untapped Global is an asset financing company that financing productive use assets across the continent, partnering with operators in different sectors. So everything from mobility, healthcare, energy. And we use this using a data-driven approach that we call smart asset financing. And A&A Collective is a community of junior to mid-level professionals, investment professionals, located globally, but that focus on Africa.
Thank you very much. As for the moderator, my name is Samuel Salako. I'm a partner in Daily Piper, Africa, Lagos. I typically do corporate work for all sort of companies, especially tech companies, from startups to PE funding. So a little bit of housekeeping. We have a 4 round of questions for our panelists. We try and keep it very short and straight to the point. Hopefully, at the end of the discussion, we'll have opportunity for questions. We have just about 40 minutes, so it's a bit tight, but we're hoping that we'll be able to deal with the issues, within that period. So if you have any questions, just jot it down, and when you have the opportunity of asking, let's keep it straight to the point. So I want to dive in right away. And I'm at a loss between Yvonne and Amee. So let me start with Amee. We look at fintech revenues that's projected to grow by 8 times, in the next, it's expected to grow in the next few years. What impact is this having on? And we also see that a lot of banks are now coming into the fintech space. So they are sort of crowding out, if I could say that, venture capitalists. What sort of impact is this having on venture capital generally?
Yeah, I mean, I think the opportunity is still immense for venture capital in fintech. When you think about just the need in the market, I mean, 90% of payments in Africa, across Africa, are still in cash. Insurance penetration outside South Africa is 3%, if not lower. The small business credit gap is huge and underserved. So I think venture capital, even with the introduction of new players and banks becoming more involved, there's still a huge opportunity for tech-enabled companies that are taking advantage of this, and that's where venture capital investors are going to be looking. Where the growth opportunities are going to come in the venture space are going to be really from what those scalable and sustainable models are. So I think that's going to be the focus of this year, is for fintech companies proving out they can justify the valuations of the past year, proving out that they can grow and execute against what they've laid out as their vision in the last year. I think that's what, especially later stage venture investors are going to be looking for off the continent.
Okay, thank you. So from what you said, it seems that the interaction between VC and fintech is still very much alive. So I'll go to you, Yvonne. You tell me, what is the current investment appetite by VC in fintech? And why is this still growing despite everything that is going on?
Yeah, no, that's a good question. I think the main thing to also understand is, first of all, fintech is a huge market. Maybe if you hear the word fintech, you may think, oh, it's just payments, but it's so much more than that. It cuts across verticals, it cuts across sectors. You think fintech, there's embedded fintech opportunities within healthcare. There's embedded fintech opportunities between agriculture. And I think that makes it a massive market, and it provides a massive opportunities for venture investors to put money in and also get their returns out. I think looking at the current fintech appetite for VCs, I know the past couple of years we saw a huge amount of money go into fintech companies. But 2022 while it was still the largest funded sector, there was a significant slowdown. If you look at the Partech report, there was a 40% decrease of funding into fintech specifically between 2021 and 2022. And I think it has a lot of what to do with, the general economic slowdown, but then also a little bit to what Amee said. There's a growing focus on unit economics and push to profitability. Now people are trying to see, okay, we've given you a lot of money, you've done a lot of things, now can you actually be profitable and make money from that? So I think there's still so many companies also still doing similar things that we've seen across markets. So I think one thing that we'll start seeing a lot more of now moving forward is kind of like the push for M&A, which we've already started doing, but I think a lot more of that across geographies, maybe even international players wanting to get into the markets, acquiring local players as a way for them to kind of quickly get into markets. But also I think one thing to note is that that's going to take time still. You're not just going to come in and say you want to buy a company and buy it tomorrow. It's going to take a couple of months, maybe even a year to close that deal. And I think a last thing to note is that while there may be a general slowdown in fintech, I think it's also kind of looking at it in the specific verticals. There may be slowdown in some verticals, but in, like, let's say payments and remittance. But I think in other verticals within it, like BNPL and embedded finance, we are seeing an uptick because of the opportunity that it presents for different players across the continent, but then also how it ties into the other sectors, similar to what I touched on in the beginning.
Well, thank you very much. Quite a lot of points you've made there. We're still going to come back to some of those, especially on the profitability aspect. So Edmund, I'm going to ask you. So we've all agreed that there's a slowdown in funding. So that means there's competition for funding for fintech. So what it means is that for them to be able to attract that funding, they must have good corporate governance. Do you think this is impacting on investment? And what sort of corporate governance considerations are you looking at to invest in fintech?
So I think there's a natural dichotomy between, on one hand, these very exciting businesses and these new teams who are there to take on these opportunities, that sort of mindset that you're there to kind of break a mold and do things differently. And that on the other hand, try to organize companies in a way that's consistent with international best practice around companies, how they should be governed in terms of how the information flows to investors. Financial services is inherently a highly regulated industry, and that on sometimes doesn't is not completely consistent with a sort of Uber type mindset of move fast and break things. So, marrying those two things, I think, is very, very important today. I think it's very important in, this decade to address the market, the capital market. And I think it's very important in terms of building sustainable businesses which are sustainable economically and sustainable from a broader stakeholder perspective.
Thank you very much. Anthony, so we heard about all the layoffs in tech industry, lately, especially in African fintech. If you look at some of the things that have been happening, this tend to suggest that perhaps they're not managing, the money that they're being given, very well. Now, are you going to be looking at a lot more monitoring of this investment and even looking at the structures of this fintech going forward before you commit your money?
Yes, so I think there will be significant changes to how we think about structures and governance. And more specifically on this, let's not just look at the founder level where we seem to believe that there was misuse of funds. When you have this conversation with founders, some of them actually partly believe that it is our fault as investors. And during that time of exuberance where we were investing based on a deck and a call, and no one's asking about a financial model, financial projections, a concrete breakdown of use of funds, then the question I would ask is, or they would ask is, do investors have grounds for questioning use of funds if you never even asked for use of funds in the first place? So to some extent, I do think as investors, that's something we need to bear in mind, because we do have a fiduciary duty given the funds we've been given by LPs to investors. So it's not just about the founders, and not that I'm siding with them.
Okay, thank you. So we go to the third round of questions, and this has to do with regulation, across the African continent. We know that across the African continent, you have different legal systems and you have different regulatory, environment. This absence of unification has really affected VC investment in terms of the investment decision, even returns at the end of the day.
You're asking how is it affecting kind of venture decision
Does
making?
it have any effect at all?
Definitely. I mean, as fintech investors, financial services is one of the most regulated spaces. So as investors, we have to feel comfortable and understand, what the regulatory environment is of a business, even at a pre-seed seed stage, in order to feel comfortable with that. But I think also we look for not just the business model and how it fits within that regulatory environment, but I look for the kind of the approach that an entrepreneur is taking to the regulatory environment. It's not a combative relationship you want to have with the regulator. It's not a sort of wild west of we'll build it and we'll figure out the regulations later. I really look for someone who understands, has a nuanced approach to what's happening in the broader environment, and is as much as they can working with regulators. And I think we are seeing across the continent, more and more regulatory bodies wanting to have dialogue with fintech companies, wanting to figure out the right approach, whether that's sandboxes that are being created or in general kind of dialogues that are being created. I think in Egypt in particular, the central bank has been very vocal, very open about wanting to work with companies. I think those are the environments that are going to help make fintech succeed. It's going to continue to have venture investors excited about opportunities, but also is going to be a little bit of the make or break for which entrepreneurs are successful in this. So, not just governance, but, ability to work with these regulators is really important. There's still room to grow, to improve on the continent in terms of the regulatory environment that we're seeing. I mean, we're global investors, so what we've seen in India or in Brazil around creating, new solutions like UPI or PIX, I mean, these are coming out of the government, coming out of, really innovative thinking that's going to set rails and set opportunities for fintech innovation to grow. So there's more to be done, but even within the environment today, we want to see startups that are working and understand what's going on today.
Okay, thank you very much, and thank you for giving us the global perspective on that. Edmund, I'm going to go again on regulation and the volatility that you find around the African continent. I find that a lot of the legal system are not particularly stable. Today there's a regulation, tomorrow they're changing it. So across the continent, what measures do you think fintech startups can actually take to mitigate this sort of volatility and ensure that they're profitable?
So again, I think financial services is an inherently highly regulated sector, and sometimes there are conflicts between being in that highly regulated environment and being, what is a disruptor to being a business that's disrupting the existing ecosystem. But I would recommend to entrepreneurs and leaders in fintech businesses who may be in the room to really invest in compliance, invest in regulatory compliance, invest in understanding where the parameters and the boundaries are, in order, one, to maximize those opportunities, but also to maintain best practice and compliance at all times. And as a pre-seed business, which is operating on a relatively low scale, which is maybe flying a little bit under the radar, the amount of scrutiny in your business is from regulators, from other stakeholders is lower. But as you grow into being a business that's done seed, A, B, much more visible in the market, much more visible in the media, the degree of scrutiny is higher. And that's where some companies start getting into a little bit of trouble. And in terms of some of the businesses that we look at and look at deploying capital into, we look to say, well, it's not just are you able to be compliant and not get into any trouble at your current size, but when you grow to 4 or 5 times your current size, are you still going to be keeping a clean reputation and performing within the confines of the rules?
Okay, interesting. It's a very, very thin line and very difficult, navigation experience. I go back to what Yvonne mentioned before, profitability and scaling. That's been the bane of most fintech in Africa. So you're looking at recent past where there's money everywhere. Right now, not much money. So Anthony, I'm asking you, what are some of the key capital management schemes that you want to see, that fintechs can adopt so that they can actually have some growth or some, numbers that will make you to be interested in investments?
When you think about growth and profitability, ideally, well, in the financial sense, ideally you're trying to play around with two levers in the business. Either is to increase revenue or to decrease costs. And the extent to which you can play around with those levers depends on what effectively you're building. Now, during tough times, as is what is expected in most African economies, people and businesses tend to prioritize buying the things they want, rather than the things they want. So discretionary spending more or less takes a backseat. For businesses that are essentially selling things that their clients need, are able to influence price and are able to maintain acquisition costs. The same cannot be said for products that are considered discretionary spending. And one exercise I would suggest to investors and founders is to look of the businesses you've invested in or the businesses you're building. One thing to consider is imagine your client's income statement, because ideally your revenue is their cost. And ask yourself where that cost sits in their income statement. If it sits in cost of sales, you're more or less on the safer side relative to a solution or a product that sits in operating expenses or administrative expenses. If it sits under financing costs, I'd say that's a safe place to be as well.
Okay, thank you very much on that. So we're still on scaling and profitability. Yvonne, next to you. So we look at M&A in every field, and M&A is usually as a result of, maybe growth or just to enjoy certain economics. What do you think? Do you think it's time for fintech, looking at the fragmentation that we see, do you think it's time for fintech to actually start considering mergers and acquisition or a sort of business combination to be more profitable and perhaps scale to the level that they want to?
I think the short answer to that is yes. But before I even go into the longer answer, I think one thing that needs to be said is that I definitely understand that it's not easy to build a business to start with. It's not easy to build a fintech business, within the regulation, like the regulatory bounds that exist across different markets. So even just getting into that journey to start building that business is a big deal. So kudos to all the founders out there that have started that journey, that have been building businesses over the past couple of years. Now, to my longer answer, I think it definitely should be encouraged, but I think in our market, it's so much more than just for profitability. When you think about M&A, it's for a couple of different reasons. Yes, to push towards profitability as a way to kind of consolidate businesses and promote operational efficiency, like Anthony mentioned. But you also have to think about it as a way to access new markets, also expanding your operational offerings across markets as well. So in line with that, it should be encouraged and also as a way to kind of like consolidate repetitive businesses across different geographies. Because there's a payment company operating in let's say Kenya, another payment company operating similarly in Nigeria. While I think the operations may be different based on the different markets, there is an advantage of them coming together and working as one and then now operating across the two markets. So I think one thing I'm going to reemphasize though is while yes, the push for M&A, I think it's positive in general, we also have to know that it is going to take time. It's not going to happen overnight. You're not going to say, I'm going to buy a company tomorrow and then end up buying the company. There's a lot of checks and balances that are going to happen. But I guess to summarize my answer, yes, we should, to promote both profitability, but then other growth factors as well, and also to promote operational efficiency.
Okay, thank you very much. Edmund?
Thank you. So one of the mandates of Verdant Capital Hybrid Fund is to support with capital businesses who are consolidating their respective sectors. So we do, Yvonne, we do completely agree with your thinking on this, that it's a potential to improve operations, to make businesses more profitable. I also agree that that M&A is inherently complex. It's not just about having a buyer who wants to go out and buy another company. You've got to have a seller who wants to sell his company. And we have a saying that people don't vote to put themselves out of work. And unfortunately, that human factor is very, very important in M&A. Is who's going to be the CEO of the combined entity, who's going to be the CFO, who's going to be the board, who's going to be leading this combined entity. Do you have one or other partner who's willing to sort of put their hand up and say, well, this is what I built so far, and it's a hell of a nice business, but I think the future is better with another larger company, and I'm quite happy to sort of drive the acquirer's agenda for the next 5 years as part of a broader team. And actually that's, we obviously see that happens quite a lot. We see people, happy to do that and incentivized and motivated to do that as part of these consolidations. And it can work very, very well. But actually a lot of the time the entrepreneurs say, well, I don't want to do that. This is my company. I don't want to work for somebody else. That's why I started my own company. And we're going to make it work. If things don't quite work out to plan, we'll make a new plan. And actually that's okay too, right? If they stay in business and look after their customers and employees, then there's nothing anybody else can do about that, right?
Interesting. Amee, do you have any take on this?
No, I think that's absolutely right. I mean, I think there's like a different kind of mindset I think we need to see for the fintech kind of market more broadly in Africa, where it's about, as a founder, how do you think about your long-term value creation? And are you going to build that on your own as a standalone company, or are you going to be a really strategic investment for another company? And again, that's kind of leave ego aside, leave everything else aside, and just think about value creation. I think as our market and our ecosystem becomes a little less nascent, becomes more mature, we're going to have more examples. We're going to have more clarity around what does a Series B, what does a Series C company look like that's a lending company? How much investment does it take to really expand from Nigeria to Kenya or vice versa? What does it look like to reach that scale that you would need to be? And then the questions become pretty natural. Do you do that organically? How much capital do you need to raise in order to do it? Or do you need to do that inorganically and either acquire or be acquired? And I think that sort of milestone-based thinking and longer-term value creation mindset is what we're going to need to kind of see big successful companies, and I do think it'll lead to more consolidation.
Okay, thank you. Anthony, do you have any view on this?
As Yvonne mentioned on M&A, it is complex. However, one view I have on the market is I see so many startups set up in Kenya, go to Nigeria or vice versa. And I'm a big believer in your circle of competence. Just because you do well in Kenya does not necessarily mean you'll do well in Nigeria. Those are two very different markets. And if you're a well-funded business, I would lean towards considering an acquisition as a way of expanding.
Thank you very much on that. Amee, I have this multi-question for you. Hopefully the last question before we go to the floor for questions. So what do you think? How can fintech startup continue to attract the sort of investments that they've been attracting in view of the downturn? That's one leg of the question. And the second leg is, what will you consider some of the attractive business models, okay, that fintech actually utilize, sort of weather through this storm?
Yeah. So on the first piece of that, again, I would go back to this is going to be the year of execution. High expectations on can fintech companies have very clear targets and prove that they can hit those targets and get to what they need for that later stage investor to put more money in. And so in order to attract, I think it's sort of cutting the noise. If you're a founder in the fintech space, what are those core things that you have to achieve? What are those things you have to prove? If you don't know what those are, how are you building relationships with those later stage investors and understanding what those milestones might be that they need to see 12 months down the line, and make sure you can hit them 6 months before, because that's when you're going to go out to market to raise. So it's a very structured, systematic approach, I think, this year, and cutting the noise of all of the other things that you might be wanting to do, but that may not look like a focus if you're especially an early stage company. On this second piece, all that said, there are massive growth opportunities in this space that we're really excited about. I'll highlight 3. At Accion Venture Lab, we're really excited about embedded finance. We talked about that earlier. I think verticalized plays that are, in particular, embedding financial services. And we have a few companies in our portfolio, Field Intelligence, which does this in health supply chains and bringing inventory financing to pharmacies and clinics in an asset-light way. I think those kind of models are the ones that really understand the customer, really build products for a need and a use case. But more broadly in embedded finance, being the enablers to help the growing number of platforms and others who don't know how to lend or don't know how to do payments, but have a customer base that could use those financial services. So we have a company called Kunda in our portfolio working across multiple markets, but bringing very, very short-term financing to small businesses by working with larger platforms. And then the third, I mentioned in the beginning, insurance penetration is less than 3% on the continent outside South Africa. Massive opportunities to think about how to bring more access. So we've got companies like Pula in the ag space, and then Lami doing insurance as a service through different platforms. I think those kind of models are incredibly exciting and have huge potential on the continent.
Wow, a lot there. Thank you very much. Edmund?
So I agree, all of those comments, but maybe to boil it down, if I was in the shoes of a successful fintech operator, successful entrepreneur, maybe I've just completed my Series A. What am I thinking about in this new environment? That conveyor belt of money has slowed. It doesn't mean it's not there anymore, but it's certainly slowed. The parameters have changed. What are the 3 things I'm thinking about? So 1, how can I become profitable or break even more quickly? How can I reduce my monthly cash burn? How can I extend my runway? How can I reach that break even point more quickly? Do I look at my OPEX? Do I look at compensation? Do I look at my growth strategy and think about what parts of my growth strategy I can turn into cash and cash flow within that runway horizon? If I'm a startup and I raise $10 million, I don't have the financial wherewithal to do moonshots like Google. Secondly, echoing the earlier comment, what product can I layer on top of my existing products or product to make more money from my existing customers? So they're existing customers, they have an existing product. Is there anything that I can embed in that existing product to make me more money more quickly? Credit is a great one. Africa is Africa, and everybody always wants credit. And if you want to have a stickier relationship with customers and make a bigger margin, credit can be an interesting add-on if you're in financial services, or even if you're in other venture businesses around logistics or B2B or marketplace models. However, credit comes with a big warning. It's easy to lend money. It's much harder to get repaid.
Yep.
So, can be a very, very good model, can be a bad model. So that's something that needs very careful preparation. Finally, when you raise money today, think about the parameters in which what the market wants today, and it's different from 2 years ago. We know entrepreneurs in the market in 2020, early 2021, saying to investors in the US that on the West Coast that they had EBITDA of X million dollars or $2 million, and the investors would laugh at them and say, well, none of your competitors are making money, and they're all growing faster than you, and they're achieving more, and we wanted you to think about the bigger vision and how you can take that company. But the world's changed, and some of these people are now laughing on the other side of their faces. That's not a bad way of putting it. So think about think about what the market wants, think about what's the right message now, and then implement that.
Okay, thank you very much. Everyone, thank you to our panelists. So we've come to the end of the formal discussion part. This is the time for your questions. If you have any questions, please signify by raising up your hand and we'll get the mic across to you. Okay, it does seem that we've covered everything, including any possible questions. So on behalf of, sorry, can you see from here?
Hi, my name is Shehryar Ali. I'm from MasterCard. And it's really enlightening to hear some of the insights that came through the panel. I think the general question would be, especially if you're coming up with a new use case or a new business model, there needs to be absorption capacity initially, because you may not see immediate success, and obviously scale takes time. And in a world where everything is request or expected to be free, for new businesses, it's always a bit of a challenge. How do you monetize your services? So if a budding fintech sitting in the crowd today entrepreneur wants to go ahead and really make a go of their business model or their idea, what kind of time span should be, something that they should keep in mind? That, hey, it's not going to be all roses all the way. It's going to take time. And I think patience and persistence is key. So in your experience, how would you advise them on that? Because it's very easy to give up early. Sorry for an open-ended question.
Okay, thank you very much. I think I have a number of takers there. Edmund, do you want to go first?
Thank you. I think it's an excellent question. And I think if you're starting a business at any time, it's best to have realistic expectations, and that helps give you the tenacity to see it out. And if you're starting a business today, you're not starting a business in 2020 with money being thrown at you and ability to have nice offices and hire a lot of people and move that journey forward. I think you've got to anticipate. We're still in a better market than we were 10 years ago for early stage companies. So it's not all doom and gloom either. And I think you want to have, if you're starting a business, you want to have the mental, and I'll say this from experience. If you're starting a business, you need to have the mental wherewithal to stick it out for 3 years. You need to think about the next 3 years of your life, and you've got the wherewithal, ideally the financial wherewithal, but more importantly, that mental capacity to tough it out for 3 years in the knowledge that things are going to be more difficult than you think it is on paper. And you've got to be agile. Mike Tyson said, everybody has a plan until they get punched in the face. Yeah. So to be ready to roll with the punches.
Thank you. Amee?
Yeah, and I think part of it goes back to me also of sort of goal setting, milestone setting for yourself. So even if you're a early stage company and you think you have something there, you have a product, and you're going into a pilot with a partner, with direct to customers, before you even start that pilot, and we do this work with our companies, who are thinking about a new product, set the KPIs for yourself of, okay, what do I need to see myself achieve? What's the timeline? And then test yourself, test that as an experiment and see how it does. That helps you with more clarity of thought, because I think it's very easy to be in the middle of a pilot and get very just so committed to it, so excited about it that you can't see with clarity whether or not it will work. So kind of set that up front so that you can more objectively determine, do I have something here? Do I need more time? Do I need to raise more capital? But I agree, expect it to be taking longer than you probably expect.
Thank you. Yvonne?
Yeah, I think it's going to be echoing everything that Edmund and Amee has said. It's going to take time. I don't think you can really put a specific time frame on it. I do like Edmund's time frame of 3 years, although I think depending on your resources, 3 years might be too long for you to kind of spend experimenting and digging into a particular solution. But to Amee's point around setting your, I'd say set your milestones and iterating within that to also understand if you actually have something to move forward with, I think it's another great idea. One other thing I would say is just also be talking to your customers, because you're not building for yourself, right? You're building for people to use your solution. You're providing a solution for people's problems. Talk to your customer. The thing, by the time you'll get to a point where you'll know if this is actually going to be a thing or if it's not. And I think it's very important to learn how to move and iterate pretty quickly. If, let's say, within the first 6 months, you've built a solution, you're testing it out, and you're providing it to customers, and it's not taking, it's okay to take a step back and be like, okay, this is not working, I may need to scrap it, and then, within the next 2 weeks, you're trying something different. I think in an ideal world, if you have the right resources and you have, like, say, resources being money, but then you also have the right people around you, you can stick it out for 3 years. But sometimes, on the continent, we're known to do a lot more with less, right? So at the end of the day, you may not have the millions of dollars to stick it out for 3 years. So it's important to kind of just keep iterating as you go. And it's okay to bow out and be like, okay, this is not working, and maybe this is not for me. And it may be in 6 months, or it may be in a year, or to Edmund's point, 3 years.
Thank you. Ant, any additional advice?
I think what I'll just quickly add is collaborate with your investors. Be very clear on what you're selling. You're an early stage business. I think it's expected that you will experiment, you will try. The main objective is what will really get you to build a big business. I see so many founders try to sell that they found out this magic elixir that will get them the billion-dollar business, but a business tops out at about Series A, Series B. So I would say collaborate with investors and be very open and honest about where you are in your journey as a founder.
Okay. Okay, we've just run out of time, but
I have another question.
I don't know if we are allowed to take one more question. One more question. Now, can you choose for us, please?
Okay, I'm Emmanuel. I have another question, but it is related from the first question. I'm Emmanuel. I'm an ICT officer at Partners Africa. We are the financial...
Sorry, we can't really hear you. If you don't mind.
I'm Emmanuel. I'm an ICT officer at the Partners. We are the school financial support. We are here in Kenya. Now, but the question is related from the first speaker. I was trying to balance between profitability and sustainability of the startups, fintech startups. I was trying to compare the cost of setting up a new fintech, the current cost, looking at the expenses, resources, skills, tax, advertisement, just to mention the few. And looking about of course you need to make some profit, which will, I don't know, from your experience, that is the question that I was asking myself, considering that you also need to comply with the structures and the policies of the market and all the requirements, putting all those things together, how and when are you going to maneuver around so that you make the good value of the investment that you're going to do? Considering this high expense, the technology is moving very fast, and the expense of everything is going up. So how do you, from your experience, when are you going to turn around so that you make something from what you're investing?
Okay, thank you. Yvonne, just for you.
I think the short answer to that is that, you would hope to start generating revenues sooner rather than later. It's very understandable. It does take money to make money. But you also, I think, depending on, when you start out, you're not going to start out hiring 100 people for your team if you don't need 100 people. So I think being able to pay attention and understand that you're going to have to use less money in the beginning, and as you grow and as you scale, you start using a lot more money. So I think it's a balance of understanding that. I think at the beginning, you're going to need to initial investments, you're going to have to get, let's say, small money to be able to start your operations and hopefully be able to start generating revenue because you've already got a product or a solution that works. Back to, I think, what we all kind of like alluded to in the last question, you can't really put a time frame on when you're going to start generating revenues or when your solution is going to be taken into the market. So it's just knowing how to be efficient enough with the money that you have right now, knowing how not to overhire or not to spend extravagantly on things that you don't need in the beginning stages until you get to a point that you know your business has the potential for scale. And then maybe you can now start spending a little bit more money to expand and grow and do things that maybe you would have liked to do in the beginning but may not have been able to. I hope that answers your question.
Okay, well, thank you very much. On behalf of ATS, thank you very much to the panelists, and thank you to the wonderful audience for listening to us for 45 odd minutes. Thank you, and see you around.